Welcome to Policy Sandbox, a conversation about the trends changing the global digital economy. We are at the epicenter of the rewiring of the global financial system, Washington, D.C., during what I think may go down in history as one of the more consequential meetings of the International Monetary Fund and the World Bank. We stand at the cusp of a platform shift that is changing the way we think about jobs, the way we think about growth, and the way we think about economic empowerment. So it's a perfect time to be here in the Policy Sandbox with two of the great thought leaders on these trends. Before we dive in, let me just mention that this is a show where we're going to share our own personal views that do not necessarily reflect the official positions of VEEI or whatever organizations we may have been affiliated with. This is about Wayne, Axel, and Todd. So please don't take this as investment advice. This is just a conversation about the big trends. But they are very important trends, so let's dig in. To quickly introduce my guests, the men who need no introduction, we have VEEI's chief economist, Wayne Best, who was rated by the Wall Street Journal as the most accurate forecaster of economic trends in 2025. He's been at VEEI 30 years and has probably done more to shape my thinking about the influence of microeconomics on the macro outlook than anyone else. I think maybe, Wayne, the best compliment I can give you is when people ask me what I'm trying to do with the VEEI Economic Empowerment Institute, I say, I want to be the Wayne Best of political science. And of course, the chairman of the VEEI Economic Empowerment Institute, Dr. Axel Weber. For those that don't know, which I think is a very small number of people in this room and in our audience, Axel was the head of the German Bundesbank during the global financial crisis, and in that role he served on the boards of many of the major international institutions, including the IMF. He was then the chair of UBS, which is by assets one of the biggest financial institutions in Europe, if not the world. He has been at the absolute apex of public policy and finance for decades. And of course, since joining the Institute Advisory Council 3 years ago, has been my North Star and sounding board. And I think after this conversation, you'll understand why. So we're so thrilled that everyone is here in the live studio audience. This is our first episode of Policy Sandbox, and I think this may be the shape of things to come. But let's dive in. My first question, Wayne, is for you. In January of this year, which now suddenly feels very, very long ago, you published your 2026 Global Economic Outlook. And that document, I think, is mandatory reading for anybody that is really watching what's happening in the world. So what you showed is how sometimes global average growth rates can mask very high peaks and very low valleys. You talked a lot about the divergences between regions and industry sectors, and you really described this as a rewiring of the economy. We're a few months into the year now, and I think a lot of those predictions seem to be very prescient. But why don't you catch us up? What's going on in the global economy, building on some of the analysis on that rewiring concept?
Sure. So, when we did that outlook, 2026 looked to be relatively average in terms of its growth. I mean, it's certainly respectable. Global GDP growth of 2.5% to 2.7% is kind of boring. It's kind of where it always sits. If we look over a long period of time, look at a standard deviation from that, it always seems to fall into that kind of area, other than when we're in actual recessions, which there's very few of course, globally. And you looked at that as a top line and says, well, this seems like another ho-hum year. And yet what we found was that there was a fundamental thing starting to occur of, as you mentioned, a rewiring of what's happening in the underpinning. And what do I mean by rewiring? Growth is holding up, people are still spending, but the rewiring was really happening, first brought about because of tariffs. Now supply chains had to be massively changed. Tariffs coming into effect were creating a lot of challenges for many businesses, and so they had to redo their supply chains. Now that's not simple. I know somebody that works at Starbucks, for example, that finds all the coffee that they need around the world. that person was busy 24/7 for months and months and months because of these varying tariffs that happened over time. So those supply chains had to be rewired. And businesses, we see this in our data, right? Because if I look at commercial card spending on Visa cards, for example, it was growing much faster on cross-border than it was domestically, as businesses would have to actually go out to those new shops or new warehouses or new factories to make sure the flows were going to be working okay, et cetera. So that was first part of the rewiring. Of course, you know, the real fundamental trend that's been happening really over the last couple of years, and now is starting to accelerate at a pace that is unbelievable, is everything related to generative AI. Yes, you're going to continue to hear about that. This is not over by any stretch. In fact, if I look at it, we're kind of on the upslope now of the S-shaped curve, which is very common as we look at what's happening in terms of new innovative trends, you know, how fast they are adopted. And in fact, they're getting adopted much quicker than what we've seen, say, with the internet or the cell phone, et cetera, et cetera. Those generative AI trends are really starting to impact all kinds of businesses. And one way for us to look at that is to look at what's been happening with the adoption rate of people paying for subscriptions to Gen AI. I mean, those are serious users. And we can look at that in our data, all anonymously, of course, and look to see how fast people are starting to adopt this tool. Well, the adoption rates are really taking off dramatically for consumers. We see it very strongly in tech hubs, for example, here in the United States and frankly North America. In fact, in Canada, that adoption rate is even faster than North America. It's happening in tech hubs and also, of course, college towns. Of course, you're right. They're using it in a much more broad way. Having the more advanced features available with a subscription is really showing up. But one of the interesting trends that we saw was that small businesses were also adopting these subscriptions and using Gen AI. In many cases, 3 to 4 times the adoption rate of consumers. Small businesses are really starting to take off with this. And it now starts to essentially redefine what it means to be a small business. You know, now one person can generate hundreds of millions of dollars of annual revenue, and are. You think about the challenges that we have with the job market currently. College graduates not able to find jobs, as an example. Well, in many cases, they're starting their own firms. New business formations in the United States, for example, and other places like Canada have been growing very rapidly as they create their own company and then start to sell that agent, if you will, to a larger company. Defining and redefining what it means to be a small business is a fascinating angle that I don't think anybody really expected. I live in the San Francisco Bay Area. We're coining millionaires every single day now. Millionaires every day because of these types of programs that they're writing and adopting. Bigger businesses have a much, much more difficult time. They've got to change the way that they do their business processes and how all of that interplays, where these small businesses are able to act and react in a much quicker way, which is something that I was just at a FinTech conference yesterday, and the adoption of some of these areas are really amazing. They're more nimble, they can move quicker on a dime. I talked to one firm that, you know, has made some substantial changes in their business processes already, which again, big businesses are going to have a challenge. You know, small businesses, as always, are the lifeblood of our communities, not only here, but around the world. And we have to pay attention to what the trends are of what's happening with those small businesses overall. So that's some of the rewiring that's happening, but there's another fundamental trend that we need to keep in mind, and that is demographic shifts, especially in advanced economies. You know what I'm talking about. 11,400 people turning 65 every single day, every day, between now and the end of this decade. We're actually at the peak of those retirements happening now and next year. And, you know, not everybody stops at 65. You know, they go a little longer, yours truly included. But in general, we see that happening. Well, that's 4 million people a year that are no longer in the labor force. The size of an economy, we call it the potential growth rate, is heavily determined by the size of the labor force. Well, in the United States, as an example, we've got 4 million less people and boomers. We also have less immigrants into this country, a drop of almost 3 million. That's 7 million people that are out of the labor force. And so it starts to create a challenge for the ability for the economy to grow. And this is not only in the United States, but every advanced economy. And that's something that we're looking at quite closely right now because it's going to shift the trends that we see. We're not going to be spending quite as much. There's not as many people out there to spend. As boomers start to age and they retire, they start to spend less. And that will be something to focus on as we go forward because those trends are not changing. You know, baby boomers stretched the economy to its extremes in the 70s when we didn't have enough schools, in the 80s when we didn't have enough houses. And now we're feeling the back end of that as boomers start to retire. Wouldn't it be nice that with this kind of challenge that we have, less people in the labor force, I don't know, that there's some kind of technology that comes along that could help improve productivity right about now? Yeah, we have it. And it's not fully baked yet. You know, small businesses, yes, able to use it, react, start to change their business models very, very quickly. That's all the rewiring we're talking about. It's going to take larger business a bit longer. And I would estimate 18 to 24 months is probably the time frame for us to see material changes in productivity. Because let's face it, it's not always easy to estimate the productivity of a knowledge worker. If you're shopping online at work because you saved all this time using AI, that didn't improve any productivity. So these are the areas that we'll have to see as larger businesses change their business processes, in many cases adapt or adopt or purchase some of these firms and able to incorporate them into their task flow. So that's what we meant by rewiring. It's a AI, generative AI area, massive investments that we're seeing right now, levels that are way beyond. In fact, if you look at 2025, again, just in the United States, if it wasn't for AI investment, business fixed investment would have been negative, big time, last year. And so that'll be an area, again, to continue to focus on as we go forward. So the AI and then the demographic shifts along with supply chain. So that's kind of a broad overview of what's been happening and changing really since we've seen January.
This is amazing. Let's bring Axel into the conversation because, of course, when I hear Wayne talking about consumers, I'm hearing voters. When I hear him talk about business owners, I'm thinking about taxpayers. The international trading system, now everyone is able to participate, but the supply chains are being recalibrated. So from a geopolitical lens, some of these trends are breeding high volatility and high levels of uncertainty. So let's bring in the global macro view. How are these trends shaping the geopolitical outlook?
Well, this is not, so I agree with many of the things that Wayne said, and this is not the first time we're seeing a rewiring of global supply chains. Latest example you will all remember is the pandemic. That was an exogenous shock and the epicenter was around the globe. And everyone felt with the pandemic, it is somewhat coming from abroad and it has a massive impact across populations. And we needed about a year to get on top of it with vaccinations and advance in medicine. But we also needed 2 or 3 years to come out of the pandemic lockdowns because things weren't where they're supposed to be. Shipping was more or less down. Transportation was down. The airline industry was grounded. So we did a rewiring, but that first rewiring was going back to the old system. So it happened quickly because it was a shock, a standstill, like a cardiac arrest. And then you go through treatment and then things open up and you go back to normal. So your destination was the past and reopening the past. This is different. Here the destination is unclear. We're going to something new and we're rewiring, and that rewiring is happening. You talked about epicenters, with a lot of geopolitical epicenters around the globe and actual wars happening now on 2 borders and perimeters of Europe. One is the war in the Middle East, which is heavily affecting supply chains for oil, and you see it every day when you go to the gas station. The second one is the war in Ukraine, and that for Europe is a very important geopolitical challenge because a former partner in oil exports, in gas exports, in general, sort of a partner of Europe, Russia, has, through this war, completely discredited itself and is no longer considered by Europe as part of their supply chain. So they have been taken out of supply chains in energy, for example, in Germany, over 2 or 3 years. We have them now to 80% out of the supply chain. It will be very hard to reintegrate Russia, but there needs to be a political consensus, and above all, there needs to be an end of fighting and a peace in order to do that. Now we have this second shock on energy, which comes from the Middle East, which is much harder and actually takes out an additional 20% of global supply. So you're seeing the price impact. My view is we've seen that many times. You have to see through it, but what is concerning for me, having been around, as you indicated, for several of these cycles, is central banks are now facing a big discussion about what to do. This is a price shock, and ideally, you would look through it because it's an energy shock, and if you look at core inflation, it's actually not yet affecting that. It might down the road if people pass on energy prices into overall prices, but at this point, it's important, as Kristalina Georgieva from the IMF said yesterday at the Global Economic Outlook, it's important to be alert and signal that you're alert. You only need to react when these second round effects materialize. But that's not what you hear from every central bank, because in the post-pandemic world, they waited too long and inflation went double digit. And it really caused a lot of distress about affordability. That's one discussion you have in this country. So central banks, having made a mistake in the past crisis, have to also make sure that they don't repeat the same mistake, like generals who often fight the last war. Central banks now have to lower credibility in keeping inflation in check because it just ripped to 10%. They face a new inflation push, and then a solid hand or waiting might not be as easy to communicate. It's harder to communicate. You need a credibility for that. Second point that I'm concerned about, Wayne already alluded to it, if you take out 1 or 2 special factors, you very often end up with global economies now bordering onto stagnation. What do I mean? If I look at US growth and I look at consumption, most of the consumption, 90%, was driven out of the top 20% of the US population. It was basically those benefiting from the stock market doing really well 2 years in a row of almost 20%. Last year it was 17%. So a massive increase in perceived wealth and spending on that and borrowing against it. The second part is, if you look at investment, it's largely driven by capex investment from these large tech companies. If you strip those factors out, and you could argue that the Magnificent Seven and their stock market performance are the key driver of the stock market performance, you're down to 7 companies and their determination and their destination driving both the investment boom and the consumption. And what we're seeing now is some doubts about whether that is not all overpriced and exaggerated and whether it really will materialize to the degree. If you look at if you look at Zuckerberg's announcement, he said there's a bigger fear of missing out in this current investment boom than basically fearing you're overinvesting. And I think he's right on that. As Wayne said, we're just seeing the start of an exponential movement coming from AI. I used to run Europe's largest bank, UBS. I pride myself now running Europe's smallest bank, which is a fintech. And I basically moved down by 2 generations in the kind of people I work with. But what is interesting is the amount of ideas that are out there by founders, by people who use technology and AI to program software, is a productivity boost in the general economy that I haven't seen over my lifetime. And it's going to be stronger than every previous productivity growth. Now, there are some areas where this will not lead to massive productivity pushes. For example, in the financial industry, in banking, it's largely an efficiency gain. You can do a lot more with more technology, but less people. And that has a downside because, as you indicated, those that are founders and that don't want to work for large institutions are doing really well. I think we'll see a new elite of investors and founders that will do really well. What you've seen with the Silicon Valley elite is something you will see globally now, and it's not concentrated on one region, it's across the industry, and it's largely a very dynamic part of our population. But like the 20% that benefited from the stock market boom, what about the other 80% that are going to be displaced by these technologies, that are going to have it harder to integrate into the job market because they don't have the types of expertise to do that? You would likely and conceivably see a further bifurcation of our societies, as if we're not already bifurcated and divided enough in many of our countries. And that, I think, is the real challenge. How do you, with such massive productivity booms, where the benefits of productivity gains are concentrated on a few, and they always have been in every part of previous technology movements, how do we deal with the rest of societies that want to have a decent living and also want to have a purpose? And I think you're going to see that the answer to that, in my view, is going to be quite different across jurisdictions and across countries. In the US, it's probably less of a redistributive approach. There's a winners and losers, I would say, dimension that could likely continue to increase. Where in Europe, policymakers are already looking at redistribution again. They're looking at how can we actually, through either wealth taxes or taxes for the rich, or higher progression in income taxes or subsidies, make life affordable for those that are on the receiving end of these technologies, and how can we make the ones that benefit hugely pay a bit for the cohesion within society. And the European cultures are much more cohesive cultures about societies not getting too diverse. And so, whilst we do have the same shock in every jurisdiction, technology, we will have very different societal answers on that. And I think that is going to be a very important part of which companies will be able to draw employees, which companies will be able to plug into these new technologies and do well. And I do see, and this is really where I agree with what Wayne said, the large banks, the large financial institutions have a much harder time because of their processes than these new startups who are, I always compare them to speedboats versus tankers. The large institutions are tankers, and getting a tanker to turn takes a long time. There are processes, there are internal procedures, and you need to follow that. These speedboats, if they see a wave, they just go sideways. And I'm very much of the view that this is actually a huge opportunity. And to go back to my core expertise, I've been a regulator. What do regulators do when they see all this innovation? Well, they regulate it. And partly they regulate it without fully understanding all the capabilities. So I think one of the biggest risks we have is that, yes, we do need rules of the game when you have a new industry develop, like fintechs, but if you regulate it out of its existence and of its future, that's not a smart approach. And the same is true when you come to other technologies. So I think regulators need to be very careful at this change in time to really allow for these technologies to develop and to prove the business case before we actually start regulating them massively before they hit consumer markets. I'm not a subscriber of any of the technologies like AI, generative AI. I have 20 apps on my, I use all of them. By construction, I ran a bank, so I'm a risk manager. Risk managers don't use just one thing. I use 20 of them, and I compare them all the time, and they're getting better, each one of them. So by the time I reached my limit with one of them, I go to the next, and by the time of the end of the day, I've basically gone through all of them, and I start again with my most favorite one, which is still ChatGPT. But things are really panning out in a completely different way. I used to have an organization at UBS that had 100,000 people. You can imagine I delegated everything down in the organization. I'm now very productive as a single person because I use these new technologies for almost doing anything. And that is, I think, a way where if you compare how the future is, you're going to get a lot more single entrepreneurs that are going to be very successful with bringing their expertise to consumers and making that grow. So I'm like Wayne, I'm very positive at what we're seeing. I do understand that regulators need to look at the risk and balance that out, in particular when it touches the mass markets and consumers. But in my view, the biggest risk we face at the moment are not these technologies per se, but the ability that we curtail them too much in what they can do and offer for a society that badly needs some productivity push because population dynamics are just not in favor of the major industrial countries. So I'm more on the side, let's move to a sandbox approach. So I like the title of the show. Let's see that we have controlled experimentation and scaling in areas that is a bit more consumer remote. Before this goes out to mass market, it needs to be accredited by regulators and it needs to be controlled, but don't sort of do that in a preventive way. Singapore and the UK have had a pretty good success with allowing some of this growth and technology to develop before they got regulated too tight. My feeling is in the US, it was a bit different, in Europe as well. The US has now gone all in without a large set of restrictions, and Europe is all out. We look at consumer protection as the major issue when we look at fintech, where the US looks at growth potential as the major issue when they look at it. And so that is a very important gulf between, and you know, bridging that with global regulation is going to be hard because the two constituencies, US and Europe, have such a different fundamental philosophical approach to how you regulate these new technologies.
Absolutely, and certainly listeners of Policy Sandbox will see in your response there, Axel, the roots of some of the fragmentation trend that we've chronicled ad nauseum in previous episodes, but I think it is a really important mega trend when you translate the geopolitics of the economy into what it means to be in the payments industry. Certainly bracing for less regulatory convergence and more divergence across geographies is a key trend that we'll be monitoring very, very closely at the VEEI Economic Empowerment Institute. Wayne, I want to bring you back into the conversation because Axel said a few words that I know are key to your analysis. I think we're seeing a shift now, to summarize, a very consumption-forward mode of growth, certainly in the West, especially in the United States, potentially buoyed by asset price increases for the top 20%, largely driven by, I think, just this general positive attitude about the growth outlook for the more affluent segment. But we're also now seeing this rewiring trend as a shift into more capital expenditure, investment-led growth, a bigger consumption, a bigger piece of GDP now coming from investment, less from consumption. Much of that driven by infrastructure, much of that infrastructure being funded by different types of not necessarily bank lending. Some private credit is getting involved. We're seeing just different models of financing that infrastructure build out. So what are you seeing in your analysis, Wayne? Are there risks that we haven't fully thought through that might actually help policymakers make better calls on this stuff?
Yeah, so a number of points there. So yeah, I mean, consumption, of course, in advanced economies is still the largest portion of GDP. But of late, what we've seen is that consumption level is starting to pull down a little bit for all the reasons I talked about, demographics, immigration changes, et cetera, et cetera. And again, the acceleration in investment that we see that is now much stronger as a contribution to GDP than we've seen over the last 10 years. If the categories of business fixed investment, equipment is doing incredibly well as people are buying new racks, new servers, new chips, all of those types of things. They continue to be quite strong. And of course, the second part of business fixed investment, which is investments in IP, so the chips, the technology, the software, those types of things are also actually the strongest category that we see. The area that we don't see a lot of coverage right now, or still declining, is in structures. And structures include office buildings, data centers, all kinds of things. So what's happening there is that, the world has changed in terms of how we work, the number of days we're in an office. A lot of companies have moved fully to remote work. And so structures have actually been negative for almost 3 years now, and we see it continuing to be a drag on business fixed investment for the next 2 years. It's interesting when you look at the chip factories that are being made. We had the CHIPS Act in the United States. If you just put a shovel in the ground, you got money to be able to expand your chip processing. Many people put shovels in the ground, but there's really, frankly, only one or two big chip factories that are fully in construction right now. The rest of them are still being paused. When you look at data centers, they continue to pop up, but now we're starting to have the challenges in the data center front from local communities. Oh, you're going to take too much water from us, or you're going to take too much on energy. And I attended, again, a FinTech conference just yesterday that talked about the massive amount of energy we're going to need. 40% increase in energy between now and 2035. Well, to cover that with solar, you're going to be covering wide swaths of almost every country. So that's not going to be the only solution. And we're going to have to look at alternative energy sources even more so, and possibly even a return to nuclear, which has all kinds of positives and negatives depending on people's perceptions, et cetera. So that's some of the changes that I see happening in terms of the investment flows. You know, there are obviously all kinds of risks. As Axel had mentioned, you know, you have problems with the big seven. They start to falter a little bit. We end up having stock market corrections, and they can be pretty big. But remember, when you see some of the volatility that we've been seeing, for example, over the last 45 days as a result of the conflict, stock markets went down a lot, and then they went back up. You know, for us to be truly concerned about this, people can kind of see their way through certain aspects, just like the Fed can see its way through higher oil prices for some period of time. You really have to make sure that your understanding of a correction in the market really has to be more sustaining. I mean, down for several months. Our estimates showed, once again in the United States, that if we look at a 10% correction, which we have seen, except that it has only been for a day here, day there. New news story comes out and the stock market pops back up. A correction would shave off around 2 percentage points of real spending in the U.S. economy. Now, what is real spending growing at currently? Around 2.5%. So that would be a pretty substantial slowdown. A lot of that, again, because of the wealth effect. As Axel had mentioned, a lot has to do with that. But I'll also add to that wealth effect is the much broader part of the population that owns homes. I mean, let's face it, home prices in this country have gone up 55% since COVID. So if you were lucky enough to get a home or are already in one during the early part of the rebound from COVID, you've also experienced a tremendous amount of wealth gains, not just from the stock market. So it does help a little bit in terms of broadening the capabilities of spending of different income groups overall.
Axel, I think that a lot of what Wayne said really, I think, resonates with what we've been discussing in the Policy Sandbox and in the VEEI Economic Empowerment Institute more broadly. But some of these transitions and the volatility that accompanies them, it really is reshaping the map. So, for example, I know you spend a lot of time in China. It used to be this consensus narrative that the U.S. was this energy importer, now we're an energy exporter. So as oil prices climb, it's paradoxically kind of a good thing for the parts of the U.S. that have exposure to the oil and gas industry. Of course, it's a downside risk from the people that have that higher energy price embedded in the products they consume. So maybe there's a price effect in the short term, there may be some demand destruction in the long term. But in China, we just saw the latest 5-year plan, which reads like an investment prospectus for some clean tech venture fund. China is so heavily invested in renewables and the energy transition that we're seeing almost a redesign, not just of the underlying wiring of the financial system, but the entire map of what these different points are, what these wires are connecting seems to be shifting. And when I think about the global map, I'm making a prediction. Wayne, you'll be proud of me. I'm following your footsteps, putting a marker down here. I predict that the word of the year for 2026 will be choke points. I've heard that word more this week than any time in my life, and there seem to be so many risks associated with this idea that there's like disproportionate points of leverage where oil has to pass through a narrow strait, or where energy has to flow through some other pipeline to get to its end user. I'd just love to get a sense, Axel, from your perspective. You talked about regulation, you talked about geopolitical fragmentation and some of the underlying drivers, but what about the kind of fragmentation that happens when there's just a fundamental difference of opinion about whether we even want to be connected or whether we actually want to use this as leverage for other reasons?
Well, look, again, I had the advantage that I've been sitting around these tables since the 90s. I've been coming to Washington almost 40 years, to be clearly transparent. At the start, as a researcher, I worked here at Brookings and at the IMF, and then later as a governor of the central bank. If you go back to the 90s, growth used to be globally, on average, almost 6%. It moved down to 5%. In the 2000s, it was 4%. In the 2010s, with the financial crisis, it was on average 3%. We're heading towards 2.5%, 2%. And that shows you, in my first meeting at the IMF, Alan Greenspan, whom you might remember, asked the governor of the Chinese central bank whether they would have a hard landing. And a hard landing at the time was the Chinese economy slowing from 15% growth to 12%. That's not a hard landing. At the moment, they try and produce 4, 4.5%, 5%. They're very optimistic about achieving 5%. So growth has come down with the level of GDP going up. Now, if the pie doesn't grow as much anymore, from 6 to 5 to 4 to 3, potentially to 2, the whole story about consumption with a growing world population is no longer about a growing pie. That's easy. It's about a pie and how to divide it. And so, as an economist, I've seen 3 or 4 waves of research, and the pattern is always the same. We have growth theory and business cycle theories follow each other. When there's good growth, everyone's concerned about growth. When growth isn't that strong, people are worried about the wiggles around the long-term trend, that is the cycle. When that starts flatlining, people are worried about distribution. And most of what we see in our society is not about growth or growth potential. It's not about the conjuncture, it's about distribution. And distribution, I mean literally global distribution, with the global pie not growing. And we know from the 70s there was a discussion about limits to growth, Meadows. We're back to another one driven by sustainability that we just seen this administration pull back from, where the limits of growth were no longer designed or discussed by what we're able to do in terms of growth, but they were defined by what the planet can take in terms of industrial growth and pollution. And so China, to your question, China's doing the right thing, but you always have to remember, China is still 80% of energy comes from coal and not from renewables. So the 20% part that they're trying to grow is simply to become more normal compared to the US and Europe in their energy mix coming from renewable, in particular coal. So China in itself, whilst they make good progress on renewables and on solar, is the biggest global polluter from traditional sources of energy. And the US, with all its resources, is one that has been very much sort of embracing new technologies. There's a different attitude in the US to Europe about technology. The US looks, for example, at nuclear, at the potential of this technology to evolve further from nuclear fusion to smaller reactors built on site. Europe looks at nuclear almost as an energy we've abandoned and we don't want to go back to, because we had some nuclear accidents on the border of Europe. You saw Japan. The German reaction to the Japanese nuclear fusion problems were an overreaction to closing all nuclear power stations. The problem was in Japan, I flew there 2 days after Fukushima because we didn't pull our people back, so how can I, as a boss of the organization, not fly to China if it's not to Japan? If it's not safe, I should bring them home. If it's safe and I leave them there, I have to go there. And that is totally different in Europe now. I must say Europe has moved a lot on renewable energy. It's one of these societal consensus where we get a lot of investment funded through subsidies if you invest in energy. I have a solar panel on my house. I have an electric car. I charge it during the day. I work from home. Whenever I need to go to the petrol station, I wave to everyone waiting there because I have an energy card that basically funds itself from solar energy. And in Europe, the programs are such that you can get up to 50–60% subsidy from the government if you make that transition from oil and gas to renewables and solar. And so it will happen in Europe because societies want it to happen. It's a political program. It's not driven by the people. It's basically the political environment that determines Europe wants to get out of this with a better mix on energy. China has very little ability to change anything short term from their energy mix. The biggest driver of what a country can do on sustainability is the energy backbone of a country. And in China, that is still very much traditional coal, gas, and oil. In the US, it's more heavily coal, gas, and oil because you have your own resources, makes you independent. Europe still has a lot of coal and gas. We just got out, as I said before, from Russian oil and gas. We now see limitations of availability of oil and gas and shortages, physical shortages, not just price rises. The US sees the price rises, but they won't see a physical shortage because you can basically substitute your own energy resources. So the global energy mix, which is a given, is what's going to drive societies and the way forward over the next 5 to 10 years, because with all these geopolitical choke points, where they are will determine on how much your global production and energy backbone is still functioning or not. If you have no own backbone on energy and it's all dependent on imported sources of energy or renewables, you better make the renewables transition very fast. This is where I would say, this is where China is, this is where Europe is. Totally different for Canada, for some of the South American countries, for the United States, who have own sources of energy. And you know, in this current environment, all of the rewiring that is happening starts from the rewiring of the energy backbone of the countries. And if you have access to energy, abundant energy, you can be an industrial country. If you need to import energy to run your industry, like Europe does, it's very hard to be a reliable industrial partner because you cannot guarantee the production because it will depend on these choke points. So, like very often in economics, starting conditions matter a lot for what countries specialize on and how reliable they are in this global environment. And I do think that, you know, from that perspective, the US is in quite a blissful situation that as a large country, you know, a continent, it has a lot of resources at its disposals which others don't have. So US tariffs, for example, have impacted massively on the rest of the world because whilst the US sort of imported a lot of these goods, the specialization on the other side of the Atlantic was on exporting these goods. And if you look at tariffs, which were quite disruptive for the rest of the world, it all moved down to something that is reasonably, you're able to cope with, but it takes a year or two to adjust. Now we're in a global environment where the division of labor is much less unclear. Before I came here, I was asked by President Macron of France to help him with 3 other economists to write a draft of what they should do at the G7, where they have the presidency in Aviance this summer. And what we did is write a report that was very much focused on what I would call first best economies. If everyone does move their levers with a view of producing a global good, we're all better off. We know that. Even if you throw in some tariffs to take off the edges of where a country feels my own industry is being hampered by so many masses of imports that undermine my own viability, you should have safety valves and escape clauses, and they do exist in GATT and in the WTO. So we recommend, well, use these safety walls, you know, use some of these for 2 to 3 years as a protection layer for your own industry to make the transition in a smooth way and in an orderly way rather than being forced by massive inflow of cheap exports that is threatening to wipe out your own industry. So we need to give everyone space to have all of the natural productions that they want to have nationally protected in transitions. But let's make it a transition issue. Don't make it a permanent issue. And then the other part is if we really crank down on global growth and we're undermining growth, this will be a lose-lose game. The first best is always everyone collaborates with everyone. Yes, you can throw in some tariffs, it's not going to be disruptive. And if there was a fear in this administration that the balance of risk and opportunities was unequal, yes, use these transitory tariffs to iron that out. On the other side, retaliatory tariffs are the worst thing you can do, because one country puts up a tariff, another country puts up a tariff. If you can't retaliate with tariffs on goods, you retaliate with tariffs on services or on financial flows. The Chinese are now using export controls rather than tariffs to limit the amount of goods that flow from China to the rest of the world in every part where they have leverage over the rest of the world, and they need that. So rare earths is one example. In a world where basically you start having industrial fights with tariffs about goods being transported back and forth, don't be surprised if financial services and services in general and technology and defense and everything else becomes part of the same discussion. So the downside we have, if we make this a conflict at the global level and we are fighting over the distribution of that little 2% growth, you're going to get it to a much worse equilibrium than if we accept that for many reasons global growth is going to be 2%. Maybe we can smooth that out by working together better. And so that was the thrust of the report that we were writing, that yes, things have become difficult, but my God, ask anybody who's my age, things have always been difficult, and with age they become more difficult. So I'm not surprised. I'm not surprised people talk about sort of these joke points nowadays, because things are complicated. But if we go down the wrong avenue of replacing the post-war collaboration that we had among all of the major countries, I mean the IMF, the World Bank, and all of that, and we're doing it because we feel we contribute too much to the rest of the world being well, and actually, growth is no longer there. We can't afford to do all of these helpful things for the rest of the world. You have to remind yourself, if we all collectively continue to do that, we're in a better place than if we start scaling back in every area where we think it's a problem. And so I think at the moment, I'm more worried about the directional change of what we're seeing rather than sort of what we're seeing already done and how disruptive that can be. Yes, we throw in a couple of special factors like the two wars, the energy, but we're in a different world where directionally we could take the wrong path. And that would lead to a much less wealthy global economy. And in the end, if the pie doesn't grow, if it shrinks, we'll all suffer.
Well, Wayne, Axel just gave us a very important opening here. He's advising the leaders of the 7 largest economies on how to adapt to this new world order. So I think we would not be doing our jobs if we didn't pass along some advice here. Axel, hopefully you can carry this forward. Wayne, I'd love to get your sense. With this, the stakes are high, but looking ahead, what would be your advice? How can the private sector, how can policymakers, how can these global institutions realistically build more trust, more resilience, and drive economic growth in this place where the final destination is no longer clear and volatility is high? What are your thoughts?
Yeah, I think you mentioned the word. I think it really all comes down to trust. Let's face it, if you trust the people that you're working with or the companies that you're working with, you'll have productive flows and a positive relationship. I think some of that trust comes from having more accurate real-time data. I mean, that's kind of the cornerstone of business economic insights that I lead. Providing those insights to our clients, to government leaders on a real-time basis, as opposed to often what happens are stale narratives that often occur. Narratives that make it sound like something is happening when the data is not showing that at all. We had a lot of people that talked about the concept of the K economy. Affluent people spending a lot and driving it, and then the lower end not spending anything at all. There's kind of that bifurcation. Our data doesn't show that in the United States. Our data shows that it's much more of a, if you will, an E-shaped economy, where right now spending across all income segments is not terribly different amongst themselves in terms of those overall levels of growth. So having insights from accurate data is something that we strive to make sure we inform our clients of. But back to the trust issue, that obviously helps build trust if you have more real-time data and can share that data and those insights associated with it. I mean, frankly, let's think about it. That's kind of the cornerstone of what Visa is all about. People trust us that when they go to use their payment device credential at a merchant that's going to work, and that their merchant is trusting us that it will result in a transaction flow and they'll get paid. If you look at some of what's been happening over the last 45 days, I mean, at the fundamental core of it, it's a lack of trust. I don't trust that you're going to do what we say you're going to do and what you said you were going to do. So I think when you start looking at some of that bifurcation that can occur, we're going to have to figure out how do we build in more trust. And that's not something that just comes because you should trust me. I tell you that. You have to show it, and sometimes it takes a while. What's happened of late may end up resulting in a lot of trust having to be rebuilt over time, and I think we all recognize that. But it all starts today. I mean, we have to continue to move in that direction. So I would really emphasize that level of trust. I think trust should be the word of the year as opposed to what you had mentioned. So because it really is going to be a cornerstone, especially as we get through the current conflict, but more importantly, and as Axel's described, the big departure that's happening in many countries that I think really needs to be looked at a lot more closely.
And maybe just to add on that, it's a good example. If you talk about what I just talked about, if you look at Visa, it's a global financial company. It serves clients throughout the world. Any German saving bank or corporate bank, you get a Visa credit card. And that is something where this is not about a US company exporting financial services to the rest of the world. It's a global financial company serving global clients. And if we lose that view of finance being global, production being global, trade being global, that's where I think the point is that you go down the wrong avenue. When I hear Europeans talk about there's too much European capital flowing into the US and facilitating growth there, in particular in the top 7 companies, and we don't have these companies, so we should limit that. Well, the better option is grow your own capital market. Europe is plagued for 20 years by not having an integrated deep capital market. The right lesson would be the US benefits from a deep global capital market. That's why money flows to the US. Europe needs to rebuild or build that global European capital market. We have a very fragmented market that is much less efficient. So the wrong lessons learned because you don't know the data could easily lead us in politics down the wrong road, because if we're starting to become more protectionist, we all know that that's not a right way to go. So let's basically focus on each delivering. And that's also the second part of the thrust of the report. Europe needs to move its own levers to become better and to compete. And that's the core action, not join that game of creating restrictions at the global level and taking down the global division of labor that we've moved to. I think the global economy, in my view, is not going to go down. People will simply not accept it. This generation has grown up in a global economy. And taking that away and erecting national borders is just not going to work around Europe. It's not going to work globally. So policymakers have to really watch it that they're not risking the kind of achievements we've had over this post-war period since the 1950s, and risking that for more nationally orientated objectives is going to be the wrong lesson learned. And I think that is something that I always took as one of the key insights in coming to Washington. All the world gathers here to talk about, with the IMF and the World Bank, how can we help actually the countries that are less privileged and less able to deal with the current repercussions. And these institutions have been put in place to coordinate and organize that joint effort. And risking that, in my view, is a much bigger problem if we were to go down that road. So I'm a bit concerned about that.
Let me bring up one last point on this too. I think one of the things that we have to make sure that we're grounding ourselves in is consumers and businesses will find a way. If you have a disruption that occurs, and some work I did with the World Economic Forum talked about persistent disruption that's likely to continue in the future, you find a way. I mean, if gas prices go up, you start taking the subway or you carpool. It doesn't happen right away. Oh, I hope those gas prices will come down, but you make that adjustment. And businesses find a way also. If you look at what the stated effective or the dutiable rate in Canada for tariffs, it's about 30% right now. So businesses found a way. They said, well, wait a minute, I export to the United States. I never signed up for the agreements of the trade agreement between the US and Canada and Mexico, the USMCA. So now I'm going to sign up. And all of a sudden, while the stated rate is 30%, the actual effective rate in Canada for tariffs is 3.5%. I don't hear anybody talking about that. Let's get back to trust again. That's an important factor. Businesses found a way. And I think this is what's going to happen. If I can't get my goods from a certain location, I'm going to figure out a way to do it something differently. That's the ingenuity and the innovativeness that we see of the consumer and the business sector that I think carries us through some of this persistent disruption, frankly, that we have now.
Well, to wrap up and summarize, maybe I'll offer sort of my key takeaway from the conversation, really, which is in a world of fragmentation and disruption, the scarce resource is connectivity. And in a world where trust is not a given, trust is the ultimate driver of value. And I think that explains one of the big paradoxes that we've all been observing, which is how is it possible that the world seems to be more fractured and yet the value of technologies that connect the world is only going up? And that's certainly the case of artificial intelligence, but it's also certainly the story of digital payments deployed through a global open network like Visa. That's the purpose of the Visa Economic Empowerment Institute, and it's absolutely the core thesis of Policy Sandbox. So to our live studio audience here in Washington, D.C., to Dr. Axel Weber, to Wayne Best, thank you so much for joining us on Policy Sandbox. It's been an awesome conversation.